All right. Thank you very much, everyone, for joining us for our next Ripple Ventures Tank Talk with Elizabeth Yin, co-founder and managing partner of Hustle Fund, to discuss how to filter for hustle as an early stage investor. Welcome, Elizabeth.
Thanks, Matt.
Just a little bit of a personal background on Elizabeth for everyone out there. Elizabeth, as I said, is the co-founder and managing partner of Hustle Fund. Prior to that, she was the partner running the Mountain View 500 Startups program, where she reviewed over 20,000 pitch decks. Prior to that, she was also the co-founder and CEO of Launchbit, which was an ad tech platform that was acquired by BuySellAds. On the personal side, Elizabeth is a graduate of Stanford University with a BS in electrical engineering and has an MBA from the MIT Sloan School of Management. She also has her own blog, which you can check out later at elizabethyin.com. Let's start off with a little bit of your personal background on the operator journey, Elizabeth. I would love to hear about your journey in starting Launchbit and the lessons you learned about building a startup that eventually exited.
Certainly. So just for some quick context, I started my company in the last recession. In late 2008, I decided to leave my cushy job at Google, and I wanted something smaller. I felt like Google was a great place, but it was way too big for me. And I decided to leave. Wonderful timing, as we all know, and could not raise any money. But that turned out to actually be a good thing because I had no idea what I was doing. And so essentially what happened was I was basically trying all these side projects, just trying to figure out something that worked. And keep in mind also, this was well before actually lean startup even came about as, a set of principles. Eric Ries was just starting to blog maybe a year later about customer development and finding product market fit. And so I was building out all these things that nobody wanted. And that was kind of the beginnings of that. Eventually, I read actually Eric Ries's first blog post on finding product market fit and how you can quickly de-risk and figure out whether you actually have something that people want, and that is typically the number one risk in building out a software startup. And that was sort of an aha moment for me, actually, that first blog post. And so then I just sort of voraciously read everything that he wrote, including the Lean Startup book. I even got to, I was fortunate to be able to see early drafts of it. So I could really learn from that. And so what happened next was actually I was building out, these other tools, and lo and behold, actually, what typically happens is if you are building out a tool that is somewhat peripheral to helping out marketers, it actually ends up in the ad space of sorts, because people are willing to actually pay for ads like crazy. Can certainly talk about that, but selling ads is actually one of the fastest sales ever. Now, the flip side is the retention is really hard as well. If you cannot perform or you don't show that this is actually good, then it's really hard to get customers to come back. So that's kind of the gist of how I ended up building out an ad technology. It's not like I was passionate about ads. It's not like it was my life's work to do ads, but that was kind of what happened in my journey.
Yeah, wow. So you didn't want to be, or you didn't think you were going to be in the ad tech space. You ended up being there. You realized how easy it was or quick it was to sell. But also on the flip side, the negative was the retention aspect. And maybe that's why ad tech platforms get 1 or 2 times revenue versus SaaS companies that get 10 or 20 times. But nonetheless, so tell us about your acquisition and sort of how that came to be and what led you there.
Yeah. So I think, this is why actually I kind of alluded to this a bit. I do think it's really important when you're thinking about your startup, like what is your goal or your mission here? Beyond money, obviously building a business, especially if along the way you get investors, the money part is certainly very important and doing right by them. But I think the key here also is like, what are the things that will keep you going, like during the tough years? In the beginning, everyone's always very excited about building a company. It almost doesn't even matter what it is. The exuberance of building a company, it will just kind of carry you through in that adrenaline. But once it starts to get hard, and, even as early as year 2, and then as you go into year 3 and 4, et cetera, what is it that keeps you going? What's sort of that guiding light? And I think, in all honesty, if you kind of look at my resume, yes, we did build out Launchbit for a while, but this is not a company that lasted 10 years. You should be thinking about what is your life's work. With Hustle Fund, actually, we intend to do this for 30 or 40 years, and I'm actually very excited about that. I was not excited about running an ad business for, certainly 30 or 40 years. And so I think, that's sort of the other flip side of it. Like, okay, if you are running an ad business, and there's certainly long lasting ad businesses, what is sort of that mission that keeps you going? I mean, arguably Google and Facebook are both ad businesses, but I'm pretty certain the mission that they state with their employees, at least for Google when I was working there, it was nothing to do with ads. It was about, making the world's information available to everybody. And so I think to that end, if I'm going to be honest, like our exit was relatively modest. We had gotten our revenue up to a certain point and it was great. But I think that, we didn't have sort of that mission to keep us through, keep morale up and keep us excited. So, in my mind, like, we were actually able to sell these ads relatively quickly. Email ads are actually even easier than banner ads or whatever to sell, et cetera. But this was a relatively smallish exit.
Right. I mean, so it was an exit, so congratulations, but it's definitely not something that you're really passionate about or wanted to dedicate the next 30 years of your life with. So you obviously exited and then transitioned on to the investor side. So let's talk about that transition to the investor role, where at 500 Startups, you and your partner, Eric, reviewed over 20,000 pitch decks. What data points did you look for to determine the best executors to fund when at 500?
So 500 Startups, just for some quick context for everyone, it's a global accelerator, and they run their accelerator program in the San Francisco Bay Area. At the time that I was there, we were running it about 3 to 4 times a year. I ramped it up to 4 times a year, so once a quarter. And in each batch, we would pick 30 to 40 companies to invest in and be part of this accelerator. And these companies would come from all over the world. So we would have to look at, decks that were coming in literally from everywhere through our online application. And in this sort of a high frequency investing model, almost by default, you end up actually looking at tens of thousands of decks, as was the case here. And so you don't have a whole lot of time to look at each one. And actually, I would say that this applies to pitching VCs in general, whether you're pitching an accelerator that looks at a lot of volume or even VCs who are seeing, a couple hundred deals a month, you still don't have a whole lot of time to capture attention. What you're really looking for as an entrepreneur is to try to capture enough attention to move into the meeting stage. Once you're in the meeting stage, then you can start to sell your company on all kinds of things, but you really only have, in our case, it was kind of like 10 seconds to capture attention in this application. And I think for 500 Startups, we were looking for very specific things. We were looking for traction. So that was an immediate filter out for everyone who's just starting an idea or hadn't gotten to a certain level. At Hustle Fund, we invest even earlier, but you still have to capture that attention. Like, what are the critical things? And I think for most companies, you can sum it up in 3 bullet points. It's like, something notable about you. And that, I think a lot of people think notable about you means schools or workplace. That isn't necessarily so. If you know a lot about your domain that you're working in, that's a big thing. That's actually a much bigger thing than anything else. Or maybe you've been doing customer development. You did 1,000 calls last week or whatever it is. Something very notable about you. If you do have any traction, and it doesn't have to be revenue, it could be LOIs with customers or even actually customer development work you've done. Like, I would definitely state that. That sets you apart from the companies that are just pitching an idea. So, we are now working with like Rakuten and Google and Facebook or something on pilots. That's very compelling. And so just having like a couple of key bullet points is really what you're looking for. We glance at it and we're like, okay, yes, we are going to interview them. At 500 Startups, we would interview companies in 20 minutes. And at the time it was by Skype, and later we moved over to Zoom. And the quality of, in all honesty, of those early Skype conversations was not always clear. But in 20 minutes, you basically have to convey the key points about your business and be very concise. And I found that the best entrepreneurs very often actually tend to be concise people. Many people would waste, 12 minutes just rambling on about themselves. And so I think, there are a lot of filters here, and this doesn't just apply to 500 Startups. If you're applying to YC or Techstars, they have a very similar format. And that was basically what we were looking for. Like, does this seem like a relatively logical statement? Have they done something in the business? Execution was kind of key. And are they worth making a bet on for the accelerator?
Wow. So you would go from a 10-second elevator pitch to a 20-minute interview, and someone would waste 20 minutes talking about nothing, basically just themselves. It reminds me of the saying, those who know a lot say little, and those who know little say a lot. And if you can be clear and concise when you have those 20 minutes, just answer the questions and not talk a lot of bullshit, you're probably going to do yourself a lot of good. So how many of the 20,000 or whatever it was per batch made it to the interview, and then from the interview to the 500 accelerator?
Oh gosh, I don't remember, but it was actually a very high hit rate. Like once you got to the interview, you had a very good chance of getting in. So if you squandered your 20 minutes, like that was pretty much an automatic ding. But if you sounded even halfway decent, then you pretty much were in.
Wow. Well, let's talk about those lessons that you learned while managing the seed program at 500 startups. How did your view of early stage companies change by the time you'd left?
So let's talk a little bit about the economics behind this model, because when I describe this model to people, I think a lot of people, including other VCs, think that it's absolutely ridiculous. It's like, how can you make a decision on investing in a company in basically 20 minutes? And the reason actually is around the economics of it. I mean, all these accelerator programs, they're coming in with their offer, their standard offer. And it varies from program to program. At the time that I was running the 500 Startups Accelerator, the offer was, I forgot, like 125K or 150K. We moved up from 125 to 150K, and it basically moved up from a 2 million post-money valuation to a 2.5 million post-money valuation. So I'm going to be very honest here, just from looking at a lot of companies, if you are an investor and you are getting into a company at that price, like if the company has half a brain and sounds somewhat decent and the idea seems pretty good, it is a worthwhile bet. There isn't too much more information you're going to learn beyond the 20 minutes and just like talking with people over and over that will make it more compelling. Now, of course, if the valuation were different, like a lot of VCs things that let's just even say 4 or 5 million posts, which doesn't seem like a big difference to many people. But when you think about it from a valuation perspective, that's a jump up of 2x. So now your expectations of the company basically is like, 2x higher. And so of course, then the bar goes up in what you need to kind of due diligence, even though it's at seed stage. So that's kind of the difference. Like these accelerators, and certainly for the ones that are getting in at, even lower valuations, the process can be that fast. And that's why they have sort of this spray and pray model where if you have so many companies, you can actually afford to mess up quite a bit, because the winners, the few winners that you do have, they will return 100x, gross multiple if they just sell for, a couple $100 million. And there will inevitably be a couple, within a cohort of 100 or so that will do that.
It's a cheap call option on a social experiment, basically.
Absolutely. So tying it back to this then, so how does that change my view? Well, I mean, I think, so to be very frank, like if you are going through an accelerator, it does not necessarily mean that a VC will fund you next. I think that's something that everyone really needs to understand, because the economics the VC is getting is very different from what the accelerator is getting. And so the accelerator can do the speedy process, but it also means that we were accepting a number of companies that we knew would not end up getting VC funded later. But it was still worthwhile for an accelerator to make that investment. And so when I was thinking about, starting a VC fund, and, certainly we would, of course, love to get that economics, and sometimes we do, depending on geography or stage. I also knew that we would often be coming in, looking at companies even at 4 million posts or 5 million posts, and that is a very different game. So the amount of de-risking that needs to happen and the process to risk would also need to change. And maybe that's segue into sort of your next point, but like at Hustle Fund, we end up actually gathering information slightly differently.
That's a perfect segue. You left 500 and you launched Hustle Fund to level the playing field for founders. And you have an amazing team. I'd love to hear about your mission first off, when you and Eric left 500 startups to launch Hustle Fund.
So I'm very influenced by the 500 startups ethos. So their global fund, and had a huge emphasis on bringing in diverse founders. And I use that term very broadly, whether it's geographics or gender or race or anything else, age even. And so I got to see and invest in a large swath of founders. And I think one of my biggest observations is that around here in Silicon Valley, there's all this pattern matching, and there's certainly a lot of critique of it. And when people talk about pattern matching, they're mostly talking about how it seems like people with a certain resume, or if you're white or male, you have more advantages in raising money around here. And I think having looked at the data, that is actually definitely true. Like I felt that as a founder with a data point of 1, but after seeing thousands of companies now, I can tell you that is definitely true. And so our goal with Hustle Fund is, we actually found, so the second point is, we actually found that while looking at all these companies at 500 startups, success actually isn't correlated with demographics. Raising money is, but success is not. So, this is why you see in TechCrunch, like there are all these companies that are high flying and they raise all this money, but it doesn't necessarily work out. So for us, what other things that we noticed were traits that if you were to pattern match against, you would actually be more successful. So for example, ability to learn things quickly or iterate with speed are highly correlated with success. I think, depending on the certain markets and ability to raise money or lack of ability to raise money, also having a low burn is often correlated with success. So things like that are correlated with success, but that actually has nothing to do with, what you look like or where you come from. So for us, our mission at Hustle Fund is we would like to change the world such that the way that investors look at companies is very different. I think right now there's sort of the standard mode of operation that many VCs do, and they may do it, unconsciously. But can we get more investors to kind of look at these other things that are actually correlated with success and are actually important? And so, 30 or 40 years from now, if I were to, be on my deathbed and look back at, what is it that I change? Well, what I would love to change is, really be able to bring out a truly fair playing field that if you do have hustle, if you have a good idea and you do have hustle, like where you can focus on one thing and iterate with speed, then you can get access to resources. That's what I would like to achieve.
Yeah, I love that. And I love that ethos that you guys have set up for yourself, that hustle mindset. I'd love to talk about how you guys internally define hustle as it relates to your experience in building startups. And have you ever found having too much hustle can be a bad thing?
Yeah. So I think two thoughts on this. So one, I think defining hustle, everybody's got a different definition of hustle. I think many people think hustle is, oh, I'm just working really hard and burning the midnight oil. That's not what I mean by hustle. And in fact, actually, there's an element of complete opposite component that I think goes into hustle, which is, I think you really have to focus on one thing as a startup, one thing at a time. It can be a different thing at a different moment, but having relentless focus and then, pushing speed on that one thing is what hustle is in our definition, our opinion. Not running around and trying to do everything, because you can run around and try to do everything in a startup and really not make any progress. So prioritizing and identifying what is important, I think, is very, very important for founders. And then the flip side of that is, well, actually, I actually recently wrote a blog post about this. It's very easy to get stressed and burned out in running a startup. And, so many former entrepreneurs I know or current entrepreneurs I know actually end up having all these stress related problems. Like, people don't talk about it, but you have all kinds of like pinched nerve problems to IBS to shingles. I mean, like I have a founder who's young and got shingles. Shingles is typically correlated with age, but it is correlated with stress. And so I think, if you end up with these problems, it's actually very hard to recover. You can manage through it, but you will end up getting flare-ups periodically. And that is not good for anybody. You're talking about seeing this in people who are in their 20s and 30s and 40s. And that feels like, gosh, people are so young to be having these problems. And I myself also started having these problems when I was in my 20s. Having too much hustle is bad. And so I think you have to think about it as like, okay, sometimes you have to sprint, but after you are done with the race, you have to know when to jog. And then if you have to sprint again, you have to sprint again. But it is a long race, or it is a long journey, but you're only racing at certain periods of time.
Yeah, absolutely. I totally agree. And also it feels like some people confuse hustle with multitasking or not willing to let go and delegate. Some founders I find, as they're really young, they want to control every process of the company: sales, engineering, product, marketing, financing. I've heard it said before, entrepreneurs cannot do all three things: build a company, fundraise for a company, and sell the company. And it's just not possible. And so a lot of founders confuse hustling with multitasking. And if they can only trust the people around them, they may not actually get shingles.
No, totally. And sometimes, actually to this specific point, sometimes it may seem impossible, but sometimes you have to make the decision to not do something. So I'll give you an example. When I was raising money for Launchbit, and there's just two of us, to your point, you can only really do one of those things. So I was fundraising, and it meant I was not doing sales. I'm not doing ad sales, and certainly not doing anything else such as building product. And my co-founder had to step in and basically stop building product, kind of manage the sales. And she's not a salesperson, but kind of to the best of her abilities, manage at least the sales that we had to kind of keep the boat afloat while I was fundraising. And that isn't necessarily an optimal situation for anybody, but sometimes you have to do that.
Yeah, absolutely. Well, let's get into the qualities that you look for when assessing founders at the early stage. How do you assess the level of hustle from a founding team?
So there are two stages for us, and this digs into what our process is compared to at 500 startups. So at 500 startups, I ran this accelerator, and one of the things I observed is when people came into my office to work, I learned so much about them. I learned so much more by watching them work than by hearing them talk in their pitch. And it occurred to me, it's really funny in this industry, as investors, we just listen to people talk, and then maybe they go away and then they come back and they talk again with us. But I found that once they got to my office, I learned sort of the good, the bad, the ugly. Are the co-founders having fights all the time? Can this person learn new skills? Or, can this person really execute with speed? All these things you cannot learn in a pitch. So we kind of assess hustle in founders in two stages. So one is certainly at the pitch stage. We ask a lot of questions around what specifically they are doing, what their top priority is for the next few months, basically how they're prioritizing and thinking about the business. And I really gravitate towards the founders. If you want to pitch us successfully, I really gravitate towards the founders who tell me a lot about, I did 500 customer development calls last week and I learned ABC, et cetera, like that over this is what my TAM is. And I actually never ask about TAM. So that's one gate. The second gate is after we invest, in most cases, we invest a $25K check. And then later, our founders get access to a private growth school here at Hustle Fund called Redwood School. And, we actually help them make sure that their analytics are set up right. And actually, depending on their customer acquisition, bring in a bunch of mentors who specifically help them with the tactics of particular customer acquisition channels. And, we learned a lot about how founders work at that point in time as well. And do they like working with us? And from that experience, we may decide to invest more money. We usually don't. We're a relatively small fund, but sometimes we do. So those are kind of the two gates for us.
Right. It sounds like you separate the talk versus the walk. You almost don't even want them to talk the talk. You just say, let's see how you walk the walk and get them to show you real things, tangible things that they're doing with their time, which at the early stage that you guys are investing in, that's the most valuable resource these entrepreneurs have is time management. And how are they prioritizing the tasks that you think have the most impact on ROI when they don't have resources like capital and team members and things like that? Yeah, that's really interesting. I would love to hear about the burnout part though, because there is this sort of, argument between, hustle good, hustle bad. So how do you help founders walk that fine line between hustle and burnout when building an early stage startup?
I would say that we don't have concerted efforts to do that, but it is a big problem. I think in smaller ways, one of the things that I try to do when I'm talking with my founders one-on-one is I really did try to ask them about how they are doing personally. It's not just about the business. I care a lot about my founders as people. I think just from a self-motivating perspective, this is a long haul and most people don't really realize that, but it is a long haul. It is hard to even continue at one place for 10 years. So if you're burned out in year 2, that's not good for anybody. And so I actually really encourage my founders to take lots of vacation, to encourage their employees to take lots of vacation and to really actually do things that are helpful for their health. I think it's a really important investment, but unfortunately, we don't have any concerted programs or anything at Hustle Fund that help with health and wellness.
Gotcha. I know it's a big proponent. You have that blog post out. At Ripple, we have our Ripple retreat where it's a weekend offsite retreat for all of our companies and founders to separate sometimes. But for founders who wear a lot of the weight on their shoulders, I find a lot of them take solo time to go camping, lock themselves in an Airbnb somewhere with like 5 books not related to business, it's just about life and stuff. It's always great to see young founders taking a liking to that type of self-development and relaxation so that they don't burn out. Because you're right, it is a 10-year journey. Our funds may go for 20, 25 years, but that's expanded over, a long period of time. Like there is a very clear, defined pressure on them every single day. And it's compressed over, maybe 3, 4, 5 years. The ones who make it 10 years for sure, hopefully they're public by then. But in the early days, there's a lot of pressure on these 21, 22-year-olds. So it's a very fine line. Can you tell us a bit about your fund investment strategy at Hustle Fund and how your investment thesis or strategy has changed since launching the fund in 2017?
So the latter one is easy. It hasn't changed. But the former is kind of alluded to it. So we do have a lot of companies. Actually, at this point, we have invested in over 160 companies across the US, Canada, and now Southeast Asia. And we invest small checks very quickly, $25,000 typically, and we can make that decision in one conversation. On occasion, we will invest more money, like 250K. So, because we're a relatively small fund, it's not like it's $1 million or anything like that. But 250K, occasionally over the course of the company's lifetime, it might be 500K, but that's very rare. That's only about 20% of the time. But I would say that given this model, it's a bit of a combination between a high frequency investing model and actually a concentrated model where we have a lot of portfolio companies. But I mean, I think if you look at how the money is concentrated, it is concentrated in about 20% of them. And so that will end up being, at least on this next fund, about 40 companies or so. Between fund 1 and fund 2, we'll have about 300 companies in so, of which about 60 companies, so 40 on fund 2 and 20 on fund 1, will end up having, some follow-on checks. So more money deployed in those companies.
So how many checks would you say you guys write a month? Of the 25 days?
Yeah, so it ends up being about 1 check per week. So about four to 5 companies a month.
Wow, that's incredible. Well, I guess my question here about how it has impacted your ability to manage investments during COVID doesn't seem to have changed much. Is there anything positive that has come out of your experience during COVID? Has anything really changed for you?
So in terms of our investing, I think we actually have been more active than ever because we've always invested over Zoom. So we didn't change our workflow in investing, but we did actually end up seeing a lot more deals over this period of time. And I have actually been averaging, 2 to 3 checks a week for myself. And then I have 2 other business partners. So we really actually accelerated our investing. I think that will end up getting pared back in the next month or so. But I think, certainly it's a mixed bag around results. And I think for companies that are in, future of work or in telemedicine, these are booming times actually for companies in those categories. And then on the flip side, companies that are selling to, they're in travel or they're selling to restaurants or other physical entertainment like that, that's tough. And so it's been a mixed bag. We have a diverse portfolio of ideas, and I think it's been a lot harder for some founders than others. But I think in general, this whole environment, at least here in the US, COVID and the things that you read in the news about police brutality and racism, and then even the murder hornets, just like everything has been quite stressful around here. We have not really recovered as well as other countries, especially with regard to COVID. So that I think continues to be just stressful in itself, even if people's businesses are, to the extent possible, normal.
Have you had any positive outcomes though with relationships to your fund or to your founders that you've seen come out of COVID? Have any of them really rebuilt their companies, like culture, their missions, their infrastructure, reporting, anything like that because of the stresses of COVID?
I think you really see who's resilient. So I have a company, they'll go unnamed for this, but they're in the travel industry. And it's just been incredible. Like, obviously they've been hit really hard, but the best entrepreneurs are the people who know they've been hit hard and still see opportunity. So they knew that all of their competitors would also be hit hard. And this company has gone up, trying to actually just acquire all these other travel companies with basically no money.
Wow.
And that, I think, is resilience, to be able to push yourself through that, even if you are bleeding and struggling, to go and be on the offense.
That's hustle.
Yeah. So I'm very impressed by them.
Yeah. Well, I mean, if you bet on hustle founders, this is the time for them to really hustle. So I'm sure there's a lot of founders in your portfolio that are doing similar things like that. Well, I'd love to learn a little bit more about your book recommendations, which is my favorite part of the talk. So can you tell us about your 3 favorite books that you put forward here today?
Yeah, so I've read a lot of books as both an entrepreneur and a VC on pretty much every startup topic you can imagine. And even though these 3 books are probably fairly well known, these are actually my favorite because I think to the extent possible, they're also the most tactical, and I tend to prefer that. Lean Startup obviously it has a special place in my heart because it really helped me with my startup, but I think these days a lot of people understand Lean Startup concepts. And then the other 2, The Hard Thing About Hard Things by Ben Horowitz, and I've also read his latest book on culture, which I also think is quite good. But The Hard Thing About Hard Things is really great because it illuminates his startup journey, and it was pretty freaking tough, like from reading that book. Have you read this book, Matt?
Absolutely. Yep.
Yeah. And I think just to be able to see, like, this is somebody who has eaten glass and then gone on to build $1 billion business and, had to make some really tough decisions. That's a great book on decision making right there and being in hard situations.
A lot of curse words and a lot of rap references.
Yeah. Predictable revenue is incredibly tactical. If you're a B2B company, like this is basically the holy grail on how to do cold emails or cold calling. We were doing that at Launchbit, and we actually had come up with an ad hoc process that was somewhat similar, but reading this book actually helped me create specialization amongst roles. Like, if you break down the steps of a sales process, what does that look like? Who do you plug in where? What do you need to do when? And that's what I think this book is great for.
That book has really held the test of time too, I've heard.
It still works. I have a lot of B2B companies who are doing cold calling and cold calls.
Yeah, I'm definitely going to have to read that one for all of our enterprise SaaS companies. Well, those are awesome suggestions. So before we wrap up, we always love to ask our guests for any final words of inspiration for our audience.
Building a startup is really tough. And so I think really digging deep as to why you're doing it, like beyond the money, but why you're doing it is really important. And I think that will end up being your guiding North Star in making it through the hard times. And so that, I think, is the most important thing to keep in mind.
That's awesome. Well, thank you so much, Elizabeth, for joining us today. It was amazing to hear your journey from operator, founder, to now Hustle Fund, managing partner, and hearing about your mission and how you want to help founders and focus on the ones that really want to hustle for the next 25 plus years. So thank you very much for joining us today in the tank.
Thanks, Matt.